This is VIX index, and this is the mega spike date of the VIX index, which is ranked either the 4th or 5th largest VIX spike in US history. Happened on August 5th, and this chart shows you that in the 7 trading days after the spike, we have VIX down 58%. Of course, when the VIX are going down, we have the stock market usually doing the opposite thing, right? Stock market making a lot of gains. And in the 7 trading days since the spike of August 5th, we're seeing a lot of gains. We're seeing Nvidia up 37%, Nikkei up 22%, we have Bitcoin up 20%, Tesla 19%, Meta 17%, Amazon 17%, Apple 15%, and so on. A lot of profits were made, so whoever bought the dip, it's being a successful trade. So the VIX index drop is actually the largest percent decline over 7 trading days since the year 1990, okay? And this is August 14th, which is 7 trading days after the August 5th VIX spike, which is experienced. And this chart shows you that in history, when a large percentage, which is this column, of VIX drop happens, okay, what happens to the S&P 500 total return? We have 1 month, 3 months, 6 months, 1 year, 2 years, 3 years out in the future. And as we can see, I think this row is very important. It's the top 20 most VIX percent drop in history on average. Okay, on average for the top 20, we have 1 month later, S&P 500 total return average 1.6%. 3 months later, 2.9%. 6 months later, 5.2%. And 1 year later, we have 14.5% S&P 500 total return. So historically speaking, the data is looking pretty positive going forward. And this chart shows you the S&P 500 index seasonality chart. It's the 20-year average ending in December 2023. So it shows us the 20-year average S&P 500 percentage each month of the year. Okay, so seasonality speaking, the 3 month ahead of us, I guess we're already in half of August. So we have August, September, and October. These 3 months are considered weak months, right? The S&P 500, as you can see, they have a pretty flat performance. But in the 2 months after it, we have November, December. Seasonality speaking, they are very strong months. Okay, so probably our expectation of return should be a little bit lower for the upcoming 2.5 months. And for Q2 earnings seasons, we're pretty much over. We have 93% of the companies in S&P 500 already reported its earnings. And this quarter is here, right? It's still showing a shaded bar. It's telling us that the Q2 is not 100% over yet. So there is a portion of the EPS is being estimated, okay? And of the 93% companies that's reported, 79% companies reported actual EPS above the estimate. That's above the 5-year average of 77% and above the 10-year average of 74%, okay? So in aggregate, companies are reporting earnings that are 3.5% above the estimate, which is below the 5-year average of 8.6% and below the 10-year average of 6.8%, okay? So as a conclusion, in this Q2, quarter number 2, we're seeing more companies beating the estimate, but the surprise, right? The extent of the surprise are much less substantial compared to the historical averages. Okay, so this chart shows you the quarterly bottom-up EPS, actual and estimate, and again, Q2 is over here. Okay, so overall, this does look like a pretty strong quarter because year over year speaking, compared to 2023, last year Q2, we are pretty much going to be up about 10.5%, right, in terms of EPS. Now, on August 23rd, you probably should have it on your calendar, Jerome Powell is expected to deliver a speech at the Fed's annual Jackson Hole monetary policy symposium, okay, and or Jackson Hole meeting. The Jackson Hole meeting is going to bring together central bankers, economists, and policymakers from all over the world to discuss important economic issues. Powell is expected to prepare the market through his speech for September rate cuts in the FOMC meeting. The size of the rate cut will be dependent on the economic data, and I want to give you some recap on the latest data that the Federal Reserve members are watching. For example, here we can see the CPI. So for the July core year-over-year CPI, we have it at 3.2%. Obviously, there is a downward trend for the core CPI. And now if we look at the 3-month annualized rate of the core CPI, it's actually down to 1.6. It's already below the 2% long-term target. But again, it's just a 3-month annualized. We need to see this thing kind of stabilize around 2%. That would be ideal. And the change in the core goods price year over year, we have it actually down 1.9% compared to a year ago. This is core goods, okay? And the change in shelter index or shelter component of the CPI, it was up 0.4% compared to a month ago. It doubles the last month monthly growth of 0.2%, but it's still kind of looking sticky in terms of shelter. Okay, so overall, the current U.S. CPI inflation situation appears to be continue to be cooling off, and the inflation is become much less of a risk than before. And in the latest July non-farm payroll data, we can see that there was 114,000 jobs created. It's forming a pretty clear downtrend in terms of job creation. Okay, so the number of jobs that's being created is slower, getting decreased. That's just telling us that there's a softening in the labor market. And of course, unemployment rate was also a part of the non-farm payroll data, with the unemployment rate skyrocketed to 4.3%. It triggered the VIX spike happened on August 5th that I showed you earlier, and also it triggered the famous SOM rule recession indicator. As we can see, the latest SOM rule is at 0.53%, right? It's above the triggering line of 0.5%. This is telling us that the Federal Reserve needs to be very cautious now, because the maximum employment is slipping away from Federal Reserve. In terms of the size of the rate cut, currently market is pricing in a 75% probability of a 0.25% rate cut. The market will be focused on watching the upcoming August CPI report and the non-farm payroll report. They will be released before the September FOMC meeting, scheduled on September 17th and 18th. And I think it's important for the investor to find out a strategy that can handle any direction in the market. One thing to consider is to allocate a percentage of your portfolio into safe and liquid fixed income asset. You should, as an investor, especially a retail investor, you should have a strategy. Okay, have a strategy to handle any possible outcomes, because anything can happen. Nobody have a crystal ball. So it doesn't matter in the future if it's a 25 basis point or a 50 basis point cut, or the market could be going up and making all-time highs again, or it can be going down and we could be starting a recession next month. Who knows? But you should have a strategy. You should have a strategy that can handle all possible outcomes. Thank you very much.